If you're looking to purchase a home in Canada or you're looking to renew your mortgage, then you're going to want to pay close attention to where interest rates are today and where they're heading. If you are new to my channel, hit the subscribe button so that you do not miss any of my crucial updates, and also hit the notification button. Let's go.
I truly believe, and people throw the word around dreams. It's all about dreams, And by the way, dreams cost nothing; they're free. The hard part is just keeping them going, and please keep them going because we're here for one simple reason. You believe in the dream, I believe in the dream, and our dreams come true. And there's no reason every one of yours can't either.
One of your biggest expenses in life is shelter costs, and one thing that influences how much you're paying is your interest rate. So today, I'm going to go over the difference between variable and fixed mortgages, what are the risks and benefit of each, and of course, my forecast. I'm going to explain this in a way that is very easy to understand because this stuff could be very complicated. Let's talk about variable rate mortgages. It's where your mortgage interest rate moves with the market. And how is that determined? Well, it is priced on the short end of the yield curve, which is the Bank of Canada's policy rate. So this is how I calculate it. I usually add a 1.25% premium on top of the Bank of Canada's lending policy rate. Today it's 3.75. So you could add the 1.25 and you get a 5% variable rate. Most lenders are offering between 5 and 6% for variable rate today. So if the Bank of Canada decides to lower interest rates to 2.75, which is highly likely, then your variable rate mortgage will be at 4%. What are some of the benefits of choosing a variable rate mortgage? Well, as interest rates come down, so will your payments. Variable rate also offers more flexibility. For example, if the bond market heads down and you like the fixed term interest rate, you could lock in your interest rate at any time with variable. You'll have to check with your lender that is actually an option for the terms and conditions of your mortgage, but oftentimes it is. And another benefit, if you want to break your mortgage and get out of it, it is often more lenient when you have a variable rate. They just charge you 3 months interest penalty. Variable rate mortgages does come with some risks. So your interest rate fluctuates and so does your payment. So if interest rates do head up, you will be paying more. I'm going to show you and explain how you can mitigate these risks if you do choose this option. Also, if you choose variable, often the mortgage is not portable. So that means if you sell your property, you're going to have to break the mortgage. If you decide to do a variable rate mortgage, you need to determine if it's right for you. For example, how is your financial situation? If interest rates went up, would you be able to handle the monthly increases in mortgage interest payments? With a fluctuating interest rate, it does pose some risks. See, the variable rate mortgage right now is quite interesting because you could potentially save a lot more money in mortgage interest as the Bank of Canada continues to cut interest rates, and they will in December and January and beyond. The variable is quite interesting in my opinion. I will show you later on in this video how you could mitigate the risk if you do decide to take that option. Now, let's talk about fixed term mortgages. This is where your interest rate remains the same for the entire term that you select. I would say this type of mortgage is for the people that want to be able to sleep at night knowing that their interest rate is fixed and they're going to be paying the exact same thing month over month. It removes the risk that is involved with fluctuating markets. How is fixed term mortgages priced? It's quite different than variable. Variable is priced on the Bank of Canada's lending policy rate, where the fixed term mortgages is priced on the Canada government bonds, which is determined by the market. I'm going to explain further in the video how the Government of Canada bonds are priced in the market and what influences those changes. Predominantly, Canadians choose between 3 and 5 year for fixed term mortgages because who wants to continually renew their mortgage? But if you think interest rates are going down and want to do a shorter term fix, They do offer it, but is significantly higher than what you would be paying for a 3 to 5 year. So how do you determine what your interest rate would be for fixed term? I actually have a secret sauce again. It is the 1.25%. So if your 5-year GOC is 3%, add the 1.25 and you get 4.25%. This trick that I just provided is just a gauge. It's not 100% accurate, but it is a good gauge. If you take a look at what lending rates are across Canada for 5-year fixed, you're going to notice that what I just provided you is fairly accurate. Now the fun part, what determines what the bond price is going to be? And they call this the bond yield. For example, remember what I said, the 3% plus the 1.25, then you know your fixed term mortgage rate. Well, what determines if that's 3%? In the month of September, we saw the 5-year GOC drop down to 2.65%, and the banks were offering 5-year fixed for under 4%. And get this, with the Bank of Canada cutting interest rates by 0.5%, we saw the bond yield go up to above 3% this month. So why in the world would it go in a different direction than the Bank of Canada cutting interest rates? Well, there's a couple reasons. First of all, we are heavily influenced by the US, and the US have had bullish job markets, and inflation and expectation continues to go up. I'm not sure if you noticed, but the US government debt exploded upwards in a short amount of time, which is stimulative to the economy and inflationary. What happens is the bond vigilantes come and they see that the government spending is going out of control. So what they do is, these are long-term investors. They sell the bonds, which causes the bond prices to drop and the yields to go up. Also, let's not forget about Donald Trump's victory. That immediately pushed bond yields up, and it's because of his economic policy. He said he's going to be slashing taxes aggressively, and that is stimulative. Think about this. Why would you put your money in a bond making 3% if you thought inflation would be 6%? And also think about this. Why would you put your money into a 3% bond if you thought that you would get a 6 to 10% return in the stock market? This is how it all works, ladies and gentlemen. The bond yield is market driven, so as there's more demand, it's going to push the bond yields down. If there's less demand, then it's going to push the bond yields up to attract investors to buy bonds. That leads me to the most important part of the video. Where are interest rates going in Canada? No one can be 100% accurate in forecasting, but when we take a look at historical data, it makes forecasting more probable. But just like a weatherman, things could change in a blink of an eye. So that's why you should definitely subscribe to my channel, because I'll be providing everybody continuous updates. All right, I have actually determined that there was a pattern forming. I want you to check out the last 6 months for the 5-year GOC. So for the last 6 months, you'll see that it went from here, it dropped all the way down to here, and now it has been heading up. So this pattern is called the inverted head and shoulders reversal. As I just showed you, we go up, we go down, and then we head back up. Here is the 5-year bond yield. I'm going to bring it over so that we can compare. Check out this trend. It is nearly identical. Chrystia Freeland had a press conference today. This will help form our forecast. Let's see what she had to say.
Okay, hi everyone. Thanks for being here. Just off the top, I'd like to point out that yesterday StatsCan published some upward revisions of Canada's GDP. They revised upward GDP for 21, 22, and 23. That is some welcome data, and it makes me even more optimistic that after a really challenging time and the deepest recession since the Great Depression itself, Canada is on track for a soft landing.
If we have that soft magical landing that Chrystia Freeland's talking about, that means the Bank of Canada won't have to slash interest rates aggressively, and economic growth would be bullish for stock markets and bearish for bonds. That means we could expect the GOC rates to go up and we will follow the head and shoulders pattern. If we get negative or moderately negative economic data, then we could see some volatility and it go up and down and sideways. How would we see the 5-year GOC go down? Well, you might have guessed it, a recession. And a recession is completely not off of the table. For example, in the month of August, we had zero economic growth because of a 4-day railway stoppage. Now we have a port strike in Vancouver and Montreal, and that is responsible for, just in BC, $800 million that is not moving. We're on day 5 of the strike, so we're well above $3.2 billion just going poof. Just so that people are aware, the ports are responsible for 45,000 jobs in BC. That is a significant amount of jobs. And guess what? The mainstream media is not reporting on all of this strikes. It is incredible. Pay attention. So let's say Chrystia Freeland is correct. That means fixed term mortgage rates are going to be going up from here. That's going to be a problem for the Bank of Canada because they're currently lowering interest rates to spur activity in the real estate market. As the fixed term mortgage rates go up because of the US Treasuries going up because of inflation, the Bank of Canada is going to be stuck. And what they're going to do is they're going to continue to slash interest rates in order to get borrowers to get into the market, and they're going to be choosing the variable rate mortgages because variable rate mortgages are going to be significantly cheaper than the fixed rate option. That is the only tool the Bank of Canada has to spur activity, is they're going to have to lower interest rates quite low in order for people just to start borrowing and spending money. So I would most likely choose that option, but I want people to be paying close attention because what happens is, if we lower our interest rates significantly and then the US inflation continues to go up, that inflation will be offloaded into Canada, meaning we're going to have an increase in inflation, and the Bank of Canada is going to have to change their policy sharply and then start increasing the interest rates, which is going to cause a lot of these borrowers to be trapped. So that is why I want you to pay close attention to my channel and do some research and pay attention to where the GOC rates are, because if they start significantly increasing, the strategy is, if you're in a variable rate mortgage, you go ahead and lock in long term. So the current strategy should be, you pick variable rate, you ride the interest rate all the way down, and if you see a rise in inflation, I would start considering locking in that rate long term. But if you're not going to be paying attention to the bond market or following me on my videos, you probably shouldn't take that option, because ultimately that could be a significant risk to you if your payment goes up substantially. It's going to be a wild ride, and I look forward to providing all of you with continuous updates. So make sure you subscribe to my channel, and if you liked this video, let me know in the comment section and hit that like button. Until next time, thanks for watching.